Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. You can find the information from the show on our website at yourlifeafterwork.com, iTunes, and various other places. Obviously, we're here weekly on WILO from 4 to 5 p.m. and Sunday mornings on Shine 99 between 10 and 11 a.m. Consider This really is a show that's much more than just the weekly headlines. We work together to try to give you insights and directions into things that you may want to consider about your financial lives. And the questions come in many directions. You can always reach us on Twitter, hashtag AskBigJoe. And of course, you can email us your questions. Consider this, that's all one word, consider this at yourlifeafterwork.com. We break the show down into what we call 5 critical financial elements. One, always begin with the end in mind. So we start with retirement income. Where is the money going to come from to maintain your standard of living? Number 2, then, is the tax plan that needs to be done each and every year before the end of the year. 3 is the investment policy statement. What's going to keep you from getting caught in a downturned market without paying attention, without having discipline to how you want to respond? 4th is life happens. It's the good and the bad and ugly of life, the things that we just normally see that take place. Last but not least is the legacy plan. Everything that we do is all about your life after work. That's the name of our website, yourlifeafterwork.com. We want to take what's going on in the world, keep you abreast of changes that matter. Sure, it's always fun to talk about markets and headlines, but what we really want to do is give you things to consider. So as I said, shoot us an email, consider this at yourlifeafterwork.com. Enjoy the show and keep in touch. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com. You are listening to the best of Consider This put together over the last few years of this show. Sherry, have you ever wanted something and then got it and then kind of weren't so sure you wanted it after all?
I don't know that that's happened to me a whole lot, actually.
Doesn't happen to me a whole lot either, but
yeah,
I'm kind of in, I'm as I read this, I'm a little bit kind of, I'm a little older, a little wiser now.
Really?
And yeah.
I'm
So
ready to hear this.
all right. So there are deals in the marketplace, and you'll hear them that are called private or public deals.
Okay.
Right. Public deals are like mutual funds. Right. Individual equities that are publicly traded.
Yep.
Publicly means it's not controlled by a small group of people, and anybody who has the money can invest in the deal.
Okay.
Okay. Then there are private deals, like the Financial Enhancement Group's got 4 owners. but we're privately held. You can't show up and say, Joe, I want to see your books.
Yeah.
You can't say, Joe, I want to buy 5% of your company.
Yeah.
You can say that. You're just not going to get an answer that you're probably wanting, right?
Sure.
Those are private deals. Well, every now and then, you will have a company that wants to raise capital.
Sure.
But doesn't want to go through all of the regulations and everything else that would be required to become publicly traded.
Okay.
Maybe they don't want to be publicly traded at all, or maybe they're startup company. So last year, the big news, and I'm sure that's what perpetuated the story. The big news last year is we had over 100 unicorns, and unicorns were companies that had been in business for less than 10 years that had a market capitalization of more than $1 billion. These were private companies that had raised capital and were now thinking about going public. Right?
Okay.
And if you ever hear anybody talk about a Reg D investment, Regulation D is an investment where you're able to put money in, but it's not publicly traded. Number one risk, obviously, is liquidity. Right, you can't get the money back out very easily, but there's a whole slew of risks. Right, when there's less regulation, there's more opportunities for scams, cons, everything else, whether or not the money can be handled, those kind of issues that exist outside of there, right? Now, accreditation is what you have to be able to invest in one of those Reg D placements. Accredited is what we call it. It's an accreditation. Totally in the past, based on resources. You had to make more than $200,000 a year, for instance, 3 of the last 5 years, $300 if you're married, or you had to have $1 million worth of net worth, excluding your home, and technically not even your retirement accounts were supposed to count. Okay. And I always made the argument, said, hey, guys, now this is a little unfair. You got somebody in Madison County, Indiana, making $150,000 a year. They're technically not accredited, but they're probably doing pretty well for themselves. Oh, yeah. Somebody in LA making $250,000 a year is they're eating beans and Wheaties and, trying to figure out how to survive.
Right.
But they're accredited and the guy here is not. I said, we need to create a fairer standard because there are business opportunities that are out there that some people need to be able to invest in. Well, as we started off the discussion, Congress listened.
Really?
And
there's a story right there.
Well, yeah, no kidding. Worse than that, 347-8. That was I mean, you talk about not being any no fight at all. 347-8 would expand the definition of an accredited investor. Under current rules, a person had to have a net worth of $1 million or make $200,000 or more annually. The legislation would allow anyone now who has a securities license.
Okay.
Right. So we've got clients that have securities licenses, by the way.
Sure.
I manage the money, but they have securities license.
Yeah, I get it. I hear the irony.
Having a securities license doesn't make you a guru in the financial world.
Sure.
If you see somebody who says they have a Series 6 or a Series 7, or that means they passed a test. Right. That does not mean they understand, what we do on a daily basis. It just means they passed a test. So that part scares me, right? Or who has professional knowledge and experience related to a specific security to participate in the private placement. The later description would apply. For instance, the author says, this scares me to death, the doctor who wants to invest in a medical device manufacturing startup. Okay. Now, does the doc understand medical devices more than me?
Sure.
Most likely, right? Is he going to understand more than most of the people who are putting money into the deal? And the answer is most likely, right? Does that mean that the doc has the necessary experience to determine whether or not the business is being ran correctly?
No.
Whether or not yes, it's a great device. Maybe they're selling like hotcakes, but that doesn't mean that they necessarily know how to do the rest.
Right.
And it's, so I'm mixed on this. Do I think the rule over the $1 million should be changed? Yes. Do I think the doctor understands the medical device issue? Yes. So I'm kind of in the middle of the road. The vote certainly wouldn't have been 347-8. When I look at this, I'm a little further away from that, than what's going on.
It was so unanimous.
And so, what concerns me is you're only allowed to have a certain number of people that invest in a Reg D account, or if you will. You're allowed to have a certain number that aren't accredited.
Yeah.
And everybody else has to be accredited.
Right.
And so Sherry, you could invest in a grant writing company. If I wasn't accredited, I couldn't. Right.
Okay. Yeah.
But does that mean that if you sit down and you explain to me the grant rating process, gave me a few books, put me on a board somewhere, that I couldn't now argue that, well, I have, who is going to regulate what I know and what I don't know, and whether this is really a good idea for me or not. It's a very interesting conversation in terms of what's going on. Here's my point, however, that I want you to keep in mind. Remember the fiduciary focus, and if you missed it, you can get segments off of the internet or iTunes anytime you want to go backwards. Yep. Our show is on yourlifeafterwork.com. That's our website for the Financial Enhancement Group. You can go there. And anytime you see the fiduciary focus, I'm going to be talking about these 4 things: risk and volatility, fees and expenses, taxes both today and tomorrow, and real return. Those are the 4 things that, as a fiduciary, I think you have to pay attention to. And I don't believe the majority of people truly understand the risk of illiquidity. Right? Can't get my money back.
Until they need to, then they understand the risk.
Well, but the number of sales that I'm seeing in indexed equity annuities right now, and there's a proliferation that's taking place.
Interesting.
And the lockup. This poor lady came to us, and lots of kids. And sit down, and it really didn't understand her money at all, but was sent to this guy and down in Indianapolis, and went down, and essentially he had locked all of her money up in about 5 different annuity programs. She asked how much she could take out. He asked, how much do you need? She said it, and he said, we can do that. So set it up. She got income for 9 years, and then all of a sudden one day the check didn't come. And she didn't understand that the contract ran out of money. So we had to work with her to help her take about a 40% reduction in income. And so that she would still be able to have enough money to be able to go. Just because you have a license, does not mean you have integrity. No. It doesn't mean that you know how to do planning, right? Yeah. So anyhow, when I look at that fiduciary focus and I look at this rule, there are a lot of people out there that will come to me to try to get me to put my clients in things that shouldn't even be allowed to exist. The businesses aren't that well thought out. They don't have the right people being able to run them, and everybody gets caught up in periods of time where the economics looks really, really strong.
Right.
And that's what it looked like last year in the internet, or in the technology space. And a big part of it's this biotech stuff. The example they use in that medical device, right? And I understand when a doc says, "Hey, I want to be able to invest." I get the point. I just worry about it overall. So anytime somebody approaches you with something where liquidity is an issue, remember that is part of that risk and volatility thing.
Sure.
And you really want to think that through. And it's, we're more than willing to have a cup of coffee with you, sit down and discuss what that really means and how it looks inside of your future. Very, very, very important to do. Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. If you got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. We'll take a break and be right back.
Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
Welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. You know, I get wound up when I start talking about retirement, Sherry.
I can tell that.
It's kind of like going to the gym,
Uh-huh.
and I can't call myself a gym rat anymore. But between football and wrestling and years, I know what people are supposed to do and what they're not supposed to do. And
Yeah.
when you see somebody doing something wrong in a gym, it just hurts, right? It's kind of I want to go over and be the coach and try to help them.
Yeah.
And that's really what happens with the way I look at the retirement
I
planning.
bet when you see somebody really messing up. I mean,
people will ask a quick question, but they don't want to. It's not even that they necessarily don't want to pay for it, right? They just want to do it on their own, and it's kind of like you're going to pull a muscle, right?
Yeah.
You're not developing what you think you're developing by doing that, and that's
Right.
what happens so often in the world of finance. And anyhow, this is what we like to call the quickest hour in radio.
It really
for
seems
Sherry
like
and I.
it.
But
Man.
I've got 3 other topics that I wanted to hit. I really wanted to finish and talk more about the retirement stuff. Sherry actually said, because I'm not allowed to know what Sherry talks about in the 5th segment. For those of you on WIBC, you don't get to hear that part of the program. So you can go to our website at yourlifeafterwork.com or iTunes, Consider This with Big Joe Clark.
Yes.
And you can hear the show, the 5th segment that way.
Yep.
But Sherry was not allowed to tell me. I don't want to know. She brings in a topic. So, when I showed her we were going to talk about retirement today, she kind of threw the paper down in disgust.
Yes.
And
Oh,
said,
come on. It wasn't discussed.
Well, it was
Frustration. Maybe.
there you go. So we're going to turn the channel to another question that I got, and I can't state the question without making it obvious who it is. But it was really the question. The broad base of it is what do older people struggle with that are over 60 that they need to be aware of financially?
Okay.
And to a large degree, folks, I'll tell you up to the beginning that you cannot predict the future. There are some things we know. We will all die, right? We all know that. Almost everybody listening to this show will lose a spouse at some point in time. Not a good thing, but it's something that we've got to be prepared for. So what are the 5 most common? And I put that into the Google browser, and it brought up an article from the Washington Post.
Mm-hmm.
And so they said, number 1, many struggle with that. Now, that's true. Now,
Mm-hmm.
I don't see a lot of the people who struggle with that. Obviously, we're wealth managers.
Yeah.
So the people who come here tend to have some resources saved up.
Their
but
debt's probably useful debt.
if they have any at all.
Right.
Most people that we take care of have already paid their houses off, whether they should have or not.
Right.
It depends on what you believe your investment return is going to be, what your tax return looks like.
Yep.
There's a combination of issues that need to go in there. But struggling with that is a real thing. People have a fear of running out of money, and I can certainly understand that. And if you have a loved one who is got debt, who is retired, or planning on retiring, you can have a conversation with them, but it's really hard to change people's habits, to a large degree. You just have to help negotiate interest rates down, things like that, where you have an opportunity to do it. Number 2, they say they face complications with reverse mortgages. I would give an amen to that. I will tell you, when reverse mortgages first came out, I thought they were dirty little things, and they were sold by people who were selling things, right? And in my opinion, trying to make a commission. I think the reverse mortgage rules and situations and oversight have changed enough that it is a worthwhile part of some financial strategies. I don't expect either of my two kids to want the house that Barb and I live in. It'll be paid off, unless I refinance it again, because again, interest rates and tax rate, it'll be paid off. And now I've got an asset that's just sitting there doing nothing that my kids won't want when I'm gone. So it's possible under the rules that we know of today that I may very well exercise a reverse mortgage depending on what the rules are there.
Sure.
They are vastly and dramatically different than where they were 15 years ago. And Sherry, as you know, I believe people put money into tax-deferred programs, 401ks and IRAs today, because of decisions that were made in 1980, either by themselves or their parents or their employers. Because in 1980, I think it was a really, really good idea.
So by that, you mean the scenario that was in place in 1980?
Right.
Yeah.
Where the top tax rate was 70%. Right?
Yeah, right.
But it changed when Reagan changed the tax code in 1986. So 31 years ago, right? The rules have changed. And I believe many people defer money that flat simply shouldn't be deferring money. But a decision was made. And so we go upon that same path. Because most people don't spend 3 days in Kansas City with me reading private letter rulings with 300 other tax geeks.
Thank
right?
goodness. Yes. That sounds like fun.
It was a lot of fun. You wouldn't believe the things that we learned.
Okay, fine.
The things that you don't know, and it's like, holy
That's
cow.
why we pay
right?
you to do
That's
this
why
stuff.
you pay. And I enjoy it, and it's my love in life. So there we go. But things change, and the things that you're familiar with, those of you that are listening to the show, the things that you do, whether it be gardening or whether it be IT stuff or computers or my pharmacists or my engineers, when things change and you love it, you catch on to that change.
Right.
When it's a tertiary issue, something that's important to you, your health or your money, right? You come up with basic conclusions like liver and onions are good for you. Right?
Yes.
And
so
then finally you find out that they're not, and it's like, we don't have to eat those anymore, right? But there's things that people do in their financial lives that they don't understand really aren't in their best interest, yet they continue to do it. I think reverse mortgages might be one of those things that we need to relook at, rethink about when people are older.
Okay.
The third one, they say some have difficulty recovering from scams or identity theft. And I would concur with that. A couple of years ago, somebody decided to borrow my Social Security number and file a tax return in my name. The IRS sent a nice regular mail letter saying, Mr. Clark, by the way, the IRS never calls. Anybody who calls that says they're from the IRS, they're not.
They're not.
Regular mail.
Interesting.
And when I called back, I kid you not, I don't believe Barb would have been able to have ever talked to them. The questions that they ask, when was your second mortgage or your mortgage before this one? What bank was it with? What was the payment? Things that I didn't even know that the IRS knew. But I mean, it was a 15-minute question and answer series. And if I didn't have the 2015 return in front of me at that, or 14 return in front of me at that time, and know everything I knew about the finances, it's tough. I mean, it's tough getting around that. The next one, there's confusion over banking products and fees. How true. People believe because they've been going to a bank forever that they can just go in and talk to the bank broker. Please don't buy anything, an investment product at a bank. They are selling things. They're not registered investment advisors. They're not fiduciaries. Insurance, 401ks, those kind of things, guys, I'm telling you, you need a professional. I use the banks. I like the banks. The bankers are my friends. That is different than putting somebody in there where you're relying on the confidence of that banking relationship is not the right answer in my mind. And there's challenges with managing finances after the death of a spouse. That is so true, especially if you're the one who's gone and you're the one who took care of the money. We have many families who come in and say, listen, I really want to do this on my own, but I'm worried if something happens to me, what happens to my spouse?
Right, exactly.
And we've got programs for that to try to help people get stuff in order where they're still able to do it today, but there's somebody who's able to take care of them in the future, and the relationships are already established when that time should happen to come. Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. If you got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. We'll take a break and be right back. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. For the last 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share that with you, what we use to protect more than 700 families, more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry before the crash in 1987, and I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and as a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the Internal Revenue Service. You can reach us at 800-928-4001 at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group Incorporated, member FINRA and SIPC. Again, that number is 800-928-4001, and you can reach us at yourlifeafterwork.com. You are listening to the best of Consider This, put together over the last few years of this show. Well, good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Sherry Contos.
We were talking about, market peaks and bottoms, and we talked about my newspaper article from, I guess it was probably a couple weeks ago now, but you can find it on our website, yourlifeafterwork.com, and as well as my LinkedIn page. But essentially said, don't confuse me with the facts.
Right.
And talked about when bad things happen in the world, whether it's assassinations, natural destruction, terrorist attacks, or even market events, that they're not as tremendous as what people would think or believe.
Right.
And I talked about the 3 different disciplines that we use inside of the Financial Enhancement Group to manage money, looking at the broad-based macro economy and the demographics and things that we see going on in the world. The second part is the fundamental analysis done by our CFA in-house, Adam Harder, and our chief investment strategist. And then the third is the technical work that is done by Andrew Thrasher, our chartered market technician. And Sherry raised her arm.
I said, I don't think most people know the difference between fundamental analysis and technical analysis.
Okay,
2 terms.
They're great, and it's a great point, and it's probably worth understanding.
Okay.
People who are typically good at fundamental are not typically good at technical.
Really?
No. I learned technical analysis in the beginning of it, what Andrew would make fun of to a large degree. It was called point and figure analysis. Charles Dow created it, I think, in 1893.
Wow. Okay.
And it's evolved to a lot more with some of the computer stuff that we have and things that we're able to look at. But what Dow would do back in the 1890s is with every stock, all 11 of them at the time, I think, that were on the Dow Jones Industrial Average, he would simply mark a dot when it went higher than it did the day before, a dot upwards or a dot downwards, if it went lower than the day before. A very, very simplistic look at
Sure.
it. But,
Yeah.
but what you were looking for were clear changing signs in the trend.
That's technical.
It's purely technical.
Okay.
He didn't care what Thomas Edison said about General Electric at the time.
Oh, yeah.
Right?
Yeah. Okay. Yeah.
What he cared about is how the stock action was taking place.
Okay. Got it.
With the theory being there could be a lot of news happening in the world that we didn't know was occurring. Right? We didn't have Twitter and Facebook and we didn't have faxes. We didn't have CNBC, right?
Right.
So today, people inappropriately, in our opinion, believe that the market is efficient. They believe that you have all of the information that I have.
Yes.
Right?
Yeah.
You have access. I will tell you, you have access to all of the data that I have. What you don't necessarily have is the wisdom to apply what all of that data means and to eliminate what my engineer clients would call signal versus noise.
Yeah.
What is something that's real that's taking place? So when I'm listening to the news story, the fake news or the real news, who knows news, right?
Yeah.
When I'm listening to it, I have to filter it out at a kind of a gut reaction, what we used to jokingly call the Buddha, right, of what was happening. In Andrew's case, under the technical side, what he's looking at is the price movement of stock, right? And so you'll hear us talk about things like relative strength. He'll talk about seasonality. Believe it or not, different stocks, different sectors have better seasons of the year than others. He'll talk about all sorts of different indicators that are in there. The ones that most people have heard about are the 50-day and the 200-day moving average. You'll hear sometimes talk about the death cross on CNBC, and that's when the 50-day moving average falls below the 200-day moving average. And you've got all of these averages that if you aren't familiar with, really sound voodooistic.
Yeah.
Right?
Yeah.
The bottom line is when I identify a situation, and I can't tell you the name of companies, that's wrong, but when I identify a situation that is demographically sound, where I expect more people to spend money there than less, right? That's why I pay attention to demographics. When I see it right for the things that I see going on in the universe, I alert Adam. Sometimes Adam finds them, sometimes I find them. Adam finds them, does the fundamental research and says, okay, the PEG ratio. You guys may talk about PE ratio. CFAs will tell you PEG ratio is more important. It's the price to earnings growth over a period of time to figure out the valuation. But he's going to look to see the return on investment, the free cash flow. He wants to know fundamentally whether this is a solid shop underneath the hood.
Under the hood, yeah.
And that's his forte and his baby, and he's very, very, very good at it. The technical analysis actually gives us a better indication of when we need to buy it or when we need to sell it.
Yeah.
So if you think about two lines, if you will, and this is, again, the most simplistic part of the technical analysis, but if you think about a pipe that's got a top and a bottom, right?
Yeah.
The bottom of the pipe is what we know as support.
Okay.
And it tends to go up, and don't ask me why, Charles Dow did this too, tends to go up at like a 45-degree angle, if you will. So it's not 90, right? It's not 180, but it's about a 45-degree angle. And this pipe is going hopefully in a direction that goes from the left to the right higher. Okay. And the bottom is support. The top of the pipe is known as resistance. And for some odd known reason, when a stock price falls, or a market price, the S&P 500, the Dow Jones, the Russell 1000, Apple, right? When a stock falls and it hits that support on the bottom of the pipe, there is some unknown force in the universe that tends to drive it back up. There are buyers that simply enter the market,
almost bounces,
coming back up, and so we want to buy, to the best of our ability, things that are close
to that,
to support. Right?
Yeah.
Because we don't want to be wrong, right? It's okay to be wrong. It's not okay to be wrong long, right? And so if you're going to make a mistake, you want to know it as quickly as possible.
Sure.
Because if it falls through the bottom of that pipe, you don't necessarily know how much further it is going to fall.
Right.
Right.
Okay.
People love to talk about Warren Buffett and how much he owns of Coca-Cola.
Right.
And Buffett openly admitted one of the worst mistakes that he made was holding onto Coca-Cola when the stock price fell through. He should have reallocated that capital, but he didn't. He just didn't, because he was so in love with the fundamentals and the story of Coca-Cola. Drinks one every day.
Yeah.
More than one, probably. The converse is also true on the top, and it's known as what we would call resistance. And when a stock tends to get to a point of resistance where it's at that high, some force tends to sell it and drive it back down.
Interesting.
And so a stock over a period of time, hopefully moving from a lower left to a higher right, will bounce naturally inside of that channel. And so you don't overreact, you don't panic, right? You pay attention to demographic changes or fundamental changes, and recognize that for those pipes, those channels are bigger for some companies and some indices than they are for others. There's some that are tighter. Some you may have a 20% variability and still be within the range. You have to know that if you're going to be able to use it, and then put those other variables that are in place. There is a reason, Sherry, why I have the team that I have. There's 25 people on the Financial Enhancement Group team. And, I've been investing for a long time. I started 2 weeks before the crash in '87. I love what I do, right? People know it's the only thing I'm really good at, right? And
I don't know about that.
Well, no, it's true. But I mean, my point is, if I thought the way that I looked at life was the only way that would get this job done, right, then I wouldn't pay for Adam, I wouldn't pay for Andrew, and I wouldn't pay for all the outside information that we bring in that I certainly couldn't afford as an individual on my own.
Oh, yeah, right.
It could not happen. So I believe greatly that people need a fiduciary. They need an individual planner that has a team behind them. You have to pay attention to the taxes. If I can't control when things are bought or sold, I can't control what goes on your tax return. It is a combination of the two. You're listening to Consider This. Joe Clark, Sherry Contos. Shoot us an email, Consider this at yourlifeafterwork.com.
Hi, I'm Sherry Contos, co-host for Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group based in Central Indiana, and Joe's passion is teaching people about their money. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $300 million for families in 31 states. The Financial Enhancement Group takes care of people who don't want to worry about their money. Join Joe and me as we address your questions about money in 5 key areas: retirement planning, tax planning, investment planning, risk management, and estate planning. And each week we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 800-928-4001. You can find out more at our website, yourlifeafterwork.com. The Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SIPC.
You are listening to the best of Consider This, put together over the last few years of this show. Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. I'm going to start the segment and make this disclaimer very, very quickly and from the beginning.
Okay.
I am not the market is falling, cover your head.
Mm-hmm.
The market is going to 1 million, better buy in now.
You don't panic.
I don't do, we are very discipline driven.
Mm-hmm.
So I'm going to give you some things that I want you to consider today.
Okay.
I don't want you to consider changing what you own. I want you to consider changing your process for how and why you own it. And I want to take you back into the time machine. The year was 1996. It was December.
Okay.
We had this very charismatic Federal Reserve chairman. His name was Alan Greenspan. And I ask most people, you have a degree in finance, so you may remember the one before, but do you remember who the Volcker? And
Volcker,
nobody knew Volcker's name, right?
Okay,
I mean,
unless everyone knew Greenspan's
unless you in my
name.
world, because of CNBC and everything else.
Right.
So in 1996, December, he issues a speech where he essentially says irrational exuberance, right?
Yeah.
So the market was just simply irrational. And he may have been right. He may have been wrong.
What
Sure
did he
was
say?
going crazy.
Why did he even bother to say
Because
that?
the valuations in his mind were way out of whack.
Okay.
And things were growing in the market quicker than they were growing in the broad-based economy. It's
Okay.
true. It's a true point.
Yeah.
The problem is the market can be wrong longer than you can be financially solvent.
The market can be wrong longer than you can be. Okay, got it.
Okay. So the market went up in 97 and 98 and 99, had a little bit of volatility. And we hit January 1st of 2000, and we watched this ugly word. And you've not heard this word, my friends, and since 2010. And so, again, this is not a scare tactic. I'm just trying to give you some things to ponder and consider.
Okay.
The word is capitulation.
Okay.
And capitulation essentially means panicked activity.
Okay.
Right? So when we talk about it, it's usually capitulation, and you can think back to the fall of 08, March of 09. People capitulated out of fear. They sold everything. They got out of the market. They hid money in the mattresses. This cannot go on forever kind of attitude.
Right. Yeah.
I'll be broke in 2 weeks at this rate.
Mm-hmm.
They capitulated out. What happened in 2000, after Y2K, the biggest non-event that never occurred, right? People capitulated in. They were tired of watching their neighbors buy new cars, their houses being paid off, having money in the market, eating at Morton Steakhouses. They were tired of it. And so even though they'd listened to Greenspan in 96 and gone through the process of this is ridiculous, eventually they capitulated. They had a panic activity, a lack of discipline, and put money back into the market right at the worst possible time.
Okay.
Now, I'll fast forward you to a more known time, if you will, for many of us. And it was January of 2008. And there's I'm not picking on E-Trade. Please don't take it that way. We keep all of our money at TD Ameritrade. I don't consider E-Trade a competitor. E-Trade is where people want to do it on their own, do it. We manage money for more than 650 families in 25 states. That's what we do. $300 million worth. So what I'm trying to take you through is that we have a discipline and a process, and I think you need to as well, because there are things that are starting to reappear. That doesn't mean that this is time to go sell. It does not mean that at all. This is not an irrational, exuberant speech.
Okay.
But in January of 08, E-Trade essentially put out a commercial where they had a baby making stock trades. You might remember it. He'd call
Yeah,
out of the
yeah,
crib.
yeah.
He had his little phone. He was
Yeah,
making
yeah.
trades. And they showed him as a marketing genius, if you will. And it debuted in the 2008 Super Bowl. The market was already off 10% by the time of the airing, and eventually another 42% over the following 13 months.
Whoa.
The message was making money is so easy that even a baby can do it.
Wow.
Well, now we fast forward. It's almost a decade later, and people forget. And now E-Trade has a new kid in town. If you see the commercial, and I haven't seen it but once or twice, but essentially it shows this dummy who's kind of flunking out of school, jumping off of his yacht, and it says the dumbest guy in high school just got a boat. Don't get mad, get E-Trade.
Wow.
Right? Now, when you start to see the masses get into the market and start behaving like that,
wow,
it is usually indicative of bad things to come.
Yeah.
Right?
Yeah.
In 2007, I had people who were trying to pull money out of IRAs to buy condos at the peak in Florida and everything else. Guys, you have to be very, very careful. So here's what I want you to consider. And again, this is not me telling you the market is going down. We are actually still bullish, but how in the world can we be bullish at this point? And the answer is we look at money through the lens of three different areas. So I'm the macro economist, if you will, and I look at the big stories. What's going on in the world? What's Merkel doing with Marconi? What's going on with Draghi? That's all Europe. What's going on in the United States with Trump versus the healthcare bill, et cetera. That's really kind of my job, paying attention to demographics and looking at it. And if you haven't been to our website, you can go find our article from last week. I said, don't argue with, or don't confuse me with the facts. And it talked about things we remembered from Katrina to Kennedy's assassination to 9/11, and what in our minds say, oh my goodness, if this happened, what would the market do? And we always think it's very, very, very negative. And if you go back and look, it wasn't. It really wasn't. And you really ought to read the article. Don't confuse me with the facts. You can find it at yourlifeafterwork.com at our website. But that's my job, is to look at things like this E-Trade commercial and the behavior of people.
That's crazy.
I have been successful at calling the bottom of markets with that behavior, with looking at that. A couple times in my career. I felt very, very blessed to be able to do it.
Yeah.
I will tell you at tops, what I do looking at macroeconomics, worrying about this, that, or the other thing does not help you, right? Does not help. I have not gotten one of those. I couldn't have told you March 10th was the top of the tech rec in 2000, right? And I'm good at this, guys. It's been my life for a long time.
Yeah.
Now, my CFA, Adam Harder, who's part of our team, one of my partners, he does the fundamental analysis of the things that we hold in the economy and the market. He doesn't try to call the bottom or top of anything. He tries to look at fair valuation to determine what percentage of our assets should be allocated to either equity or fixed income, whether it should be international, whether it should be here, whether it should be in an individual equity, or whether it should be in an industry. That's his job, chief investment strategist. Many of you who are listening to this program who do this on your own function that same way, and there's nothing wrong with it. But let me remind you, that's 1/3 of the equation. Andrew Thrasher is our chartered market technician. He doesn't pay attention to the fundamentals, and he doesn't care about anybody's last name or who they're talking with or what dinner they're having, what tax code's changing, what bill is happening. He looks purely at the technicals of the market. And some people say, well, Joe, that sounds like voodoo. Let me remind you, technical analysis started really in the 1890s. We didn't do fundamental analysis until after the Great Depression, when companies finally had to start reporting and giving us K1s and the quarterly reports and the annual report. So it's not hooey-pooey. And what I will tell you is I believe technical analysis is better at finding the top than I ever will be at my discipline of finding the bottom.
Technical analysis, I mean, I don't know we have time, but I don't even know what that is.
It's paying attention to the money. There's an old expression that says the trend is your friend.
Okay.
And it's essentially a bunch of different mechanisms that follow is the trend of an individual equity, the trend of an industry, the trend of a country, the trend of a market, the trend of investment going in a positive direction or negative direction.
Almost prediction.
And it's no. It's not predictive. It's telling you what's happened in the past, thus what will most likely occur in the future.
Well, okay.
And so it is a series of probabilities that they use based on a long-term experience. Folks, don't change your holdings today, but you might want to reconsider your discipline. Shoot us an email with your questions. Consider this at yourlifeafterwork.com. Sherry and I got to take a break. We'll be right back. Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com. Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Sherry's favorite part of the show. She gets to ask me questions that I may or may know nothing. I know nothing about the topic until she presents it. Then maybe I know or know something. What I will tell you is I would always recommend, and just to follow up that last segment, that if you're out there and you care about your finances, I think, one, you need to find a fiduciary. That's somebody that's going to treat your money as if it were was or theirs, and they were in the same situation. Second, I think you need to find a business model. It's you need to ask that person, how do you know you're going to be in business next year?
Yeah, that's a good point.
Don't ask that question, right? The guy who asked me and said, hey, I'm looking for a CFP, so he knew that he wanted somebody to be credentialed, so that they had formal education in this, and wasn't just calling themselves a wealth manager or a financial planner. I think that was important. 10 years more of experience. Lord knows I know more today, 29 years later, than I knew the first day out of CFP school. I mean, that just is a natural part that happens. Seen more things. And that's, there's 5 others that are on the team that are all in the CFP program. One's already another certified financial planner. I think that's an important thing to have. Anyhow, into soapbox. Sherry, you're up.
Okay, so today, I'm a little nervous about this because I don't know anything about this topic. I chose one that always confuses me, and I have a tendency to be negative about it.
Aha. Okay.
Here. So this is about put options.
Okay.
Put options. Prices are plunging, so buy a put. That's the title of the.
Prices are plunging, so buy a put.
So I would like you first of all to explain, and I know there are different types. I was reading about the marriage put.
There's all
kinds of puts. But for me, put option has always meant insurance policy against falling prices. So
here's where you're going with, you don't know what you don't know, but you don't know what our listeners. Many of you have never heard of an option or been exposed to it.
Right. Yep.
Right. So let's start there.
Right.
An option is something that merely gives you the right to do something.
Okay. Yeah.
And it's always priced based on time and the expected level of volatility.
Right.
Okay. That's how it's priced. So there are options that are called call options.
Right.
Call options are ones that give you the ability to buy a stock in the future at a price that you're going to state. So let's say there's a stock that's $100 a share, and you're willing to, because you don't have as much money right now, or you like trading in options, which are time and volatility.
Right.
So you may buy an option from somebody. Sherry may own Apple, right?
Right.
And you may want to buy an option that says, I'm willing to buy Apple at $145 a share, which is a little more than what it's at right now, right? And so so you get a charge what's called a premium, right? Because you're selling me the option to buy Apple at a price.
So what is the product?
That is the product.
The product is not the stock. The product is the ability to buy the stock.
The ability to buy that
so
stock
at
a given price within a given date.
Like I'm buying the right. Like if you own the stock, I'm buying the right to buy your stock. You're signing off on it.
Yeah, and you can buy other stock to cover it if you want to. You don't necessarily have to sell your Apple.
This is why I don't.
You can buy more Apple, but that's a call, and it's in my opinion, it's relatively aggressive. We don't use them for anybody in here in the families we serve. There was a big shop in Indianapolis, friends of mine, that went around the world and told people that options were a very safe investment, and lost a lot of money for people in the last year, which is very, very difficult to do. But anyhow, that's a call. But when you have no volatility and options are based on volatility and time,
right.
you can lose money quickly, right?
Yeah.
So what's a put? A put is when I have the right to sell you my stock at a given price. And that's where you have the...
Don't I always have the right to sell
That's when you have
stock?
not at a given price. Let's say I owned a company that's now $100 a share.
Yeah.
But I'm fearful it's going to go down.
Right, exactly.
Right? I'm fearful.
That's what the situation...
And the key word is
okay.
here, you have to hear, folks, is fear. Fear.
Okay.
I buy insurance on my cars and on my house for the fear of something bad occurring.
Right. That's why I say this is a fear-based...
But that's on a put, not a call.
Okay.
So I buy a put. So I've got my stock at $100 a share, and I fear that it could fall to 60.
And I don't want it to.
But I don't want to sell it. But I don't want it to fall to 60.
Right. Okay.
So I buy an insurance policy
Right.
that says if it happens to fall to 80 or below, you have to buy it at 80. So I wake up one morning and it falls to 60, but I've got an insurance policy that only let it fall to 80. Now, Sherry, because she bought the put, has to come up with the other money. Okay? You've got to come up with the money to do it.
Okay.
So why did you buy the put? Now, this is something that we do use inside of the Financial Enhancement Group.
Okay.
Because people pay extra for fear. Right?
Okay.
People tend to overassess risk.
Right.
And they will buy puts that don't necessarily ever come to fruition.
Right. So then what?
But they sleep better at night. So anytime you buy an insurance policy, what do you pay?
The premium.
A premium. Premium's income. Right?
So if I'm buying a put, I'm paying a premium.
Absolutely. And I'm writing the insurance policy. Me, Joe Clark, and my brokerage account.
Okay.
I'm writing the insurance policy. It's called writing a put.
Okay.
Right?
Yeah.
I'm writing the insurance policy. So I've agreed to cover your $100 stock. Anything between 180 is not on me at all.
Mm-hmm.
But if it falls below 80, I have to pay you the difference. I've got to cover it.
So why would you do that? Because you don't think
because
it's going to?
I don't believe it'll fall below 80.
I see.
And the trend, the tendency is for people to overpay premiums. That's why insurance companies have big buildings. Right?
Yeah.
It's you don't see Progressive going under or Geico going under.
Yeah.
You don't see Allstate going under.
Right.
People pay more in premiums than what they necessarily need to pay.
Mm-hmm.
But to protect yourself, you're willing to pay that. In the pool of things, you're okay. So we don't buy a put unless it's an odd situation. We write a put rather. Unless it's a very odd situation. What we do is buy a group of them that have covered a bunch of companies without a lot of volatility, where we believe people are paying for more fear than they ought to be. And maybe one or two of them are wrong, but 8 or 15 of them are right. And we end up collecting a premium, a payment that is greater than what we could get in buying a simple bond or certainly a CD or something of that nature. Should this be 20% of your portfolio? Not in my opinion. Should it be 5 to 8% of your portfolio? It very might fit.
Really?
Absolutely. And
wow.
And it's something as a fiduciary, right? My job is to treat your money as if it were my money and we were in the same situation.
Yeah. But
so you don't put too much there.
No, but how would a normal, regular,
they
average...
wouldn't, Sherry, for God's sakes. This is what I try
that's what I'm saying. I don't...
No, this is what I'm saying. You write grants. I don't write grants. Not my job. I looked at the nurse that came to the library the other day and she said, Joe, how do I figure this out? And I looked at her and I said, I'm glad you're here. Who in the world would come to the library at 6:00 on a sunny summer evening to hear somebody talk about tax and investing? And the answer is she did. And she goes, how do I figure this out on my own? And I said, what would you do if I told you I was going to show up tomorrow with a stethoscope and a needle and play nurse?
Yes,
she said, well, you can't do that. The bad news is in the United States of America, we do not let you do anything that kills you quickly.
Right.
We will not give you Vicodin. We will not let you shoot yourself with medicine. We will not let you do it, but it's something that kills you slowly.
Yeah.
Tobacco, alcohol.
Yeah, we'll do
and
it.
managing your own money.
Yeah.
Right? We think it's our God-given right, and we ought to be able to do it. And folks, some of you are really getting hurt. And yes, it's a passion of mine, but there's tools that are out there. There's a reason why there's 25 of us on a team. We all need help. You are listening to the best of Consider This, put together over the last few years of this show Monopoly. Remember,
That's what you're thinking about.
That's what's got me.
Why? You've been playing Monopoly like all weekend?
I play Monopoly whenever I can with people who truly enjoy the game.
Okay.
I remember when I was a little boy, we had this little gray safe. It actually had a combination on the front, and I would get whatever little allowance or what money I would make selling grit and newspapers. If you remember those, when somebody knock on your door, I was one of those kids.
5 a.m.
I didn't do it at 5 a.m., but I would knock on doors after school. I delivered the papers in the paper route at 5 a.m. That was true. We had to go to downtown Muncie to pick up the papers to be able to deliver them.
Sure.
Anyhow, I like to count. I would count that money a lot, and I think it truly helped with my math skills.
Sure.
I've watched as I taught at Purdue for 7 years, seniors in Purdue not being able to figure out what 10% of something was. And
I know, because of the phone and computers.
It drove me insane. That how do you have to think what 15% of a dollar is?
Yeah.
Or when you go to the restaurant and they give you the tip guide. Here's 10%. If you can't figure out what 10% is and then double it to get to 20,
there's a problem.
Maybe you need to be in school and not eating out. Just saying. Anyhow, so Monopoly was one of those things that I think teaches kids how to understand value, right? Because you got to know whether you're buying a house or whether you're buying a hotel, whether you should buy that property,
sure,
what that property is truly worth to you.
The potential upside of that property and the downside.
Understanding value is an important thing, and being able to use currency, though it was funny looking currency, being able to use, the $500 or the $50 or even the little dollar bills, being able to use those to understand, this is the value that you're trading. This is the currency that you're trading to get this back, I think is a very important educational lesson.
Yes.
Okay. But Monopoly just went electronic. So now there's no banker. There's no banker position. Everybody has essentially an ATM card. And when you decide you want to buy the hotel, you insert your card and it will deduct for you or keep track of the amount of money that you have.
For real?
This is for real.
For real?
For real.
If I go to a store and I buy a box game and it says Monopoly,
you may still have an option to be able to do both for a while. But yes, the banker position has been eliminated. You're now going to use the ATM card, and I have an issue with that.
I do too, because how is someone supposed to understand where it's like? What is that? Is that like a magic fairy? The ATM? I mean, it's not. You know what I mean? It's kind of like people go to a bank machine.
I remember when we first started having the machines, the ATMs where we could pull currency out.
Yeah.
That people thought Americans really could just push buttons and get money in foreign countries when they saw that happening. So it really was a cultural problem. But I just never thought about watching Monopoly change. And one of the things that we do for the families that we take care of, for their grandkids and their children, we send out academic or financial academic games each year.
Seriously?
So yeah, they get a birthday card or something like that with a little present. But 6 months after that, we send them out something for people that are essentially ages 4, to 8, then 8, or 9 to 12. So there's 4 different sets, and the letter goes to the parents and says, here's a game that you can play with your kids to try to teach them things. And I've not added Monopoly because I didn't think you needed. Monopoly was doing a fine job on its own.
Yeah.
I may have to pick up the Monopoly thing, but we're actually doing something this in the summer with the Indianapolis Indians, where we're having a grandparents camp.
Aww.
And part of that is where the grandparent can bring in their kids. And we're going to play a financial game to try to teach kids how to invest better and understand what happens. And you got to be thinking about this, folks. We all have errors. We all have beneficiaries. It may be your goal to hand the mortician the last dollar when they're getting ready to close the coffin. It just doesn't work because we don't know when God is going to call us home. We just do not have that ability. So somebody is going to get what you have saved and accumulated. My opinion, I would rather them know how to handle money while I'm alive. So that I can fix it when I'm still here, as opposed to give them a large sum of money, hopefully at the end that they don't know what they're doing with.
Well, and think how you're setting them up for life, because so few people your grandkids' age are going to know how to handle money. If you teach them, they're going to be like way ahead.
We are going to play Monopoly at the Clark household.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com.